Today we're going to be talking about one of the most important pillars in trading ICT concepts. This is one of those things that make ICT make sense and brings everything together. Power of three: accumulation, manipulation, distribution. If you're someone who's like, oh yeah, I know what power of three is, but I don't really know how to use it within my day trading, or I kind of know power of three, but it's really confusing, like, okay, make it make sense for me. Or you're someone that's traded, you know power of three, but then you always find yourself that you get in a trade, and then after you being taken off the trade, price immediately goes in the direction you're predicting, and that is so frustrating. And that's why understanding power of three and the key insights I'm going to share with you in this video is so important, because it's going to allow you to know when on where the manipulation should happen. It's going to give you an over understanding of how price should deliver, which is going to increase your understanding of how daily buy should look like. And by you understanding that, it's going to give you an edge over everyone else, and it's just going to allow you to take much better and a higher probability setups. So be sure to stick around and watch this video all the way through to the end, because it's just going to click and make sense for you after this. All right, so what is power of three? Right, power of three, what is it? It's literally just a fancy way of saying accumulation, manipulation, and distribution. AMD. Some of you guys may have heard this before. And what it literally is the structure of how a price run is delivered. And what do I mean by that? If we're bullish, right, we want to see price give a measure of an opposite move against the intended direction of price. What do I mean? So if we're bullish, we literally want to see price move lower before it moves higher, and that is literally it. And what that signifies is that this move lower here is what sucks traders in. So as price is moving lower, traders are thinking sell, 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 but then price then starts to turn around, and then this selling is what generates liquidity in the marketplace, and that's what's going to be the jet fuel engine for the intended direction of price. And then once price starts to turn around and actually starts going towards the intended direction, this is the distribution. And this is what then highlights the participation of smart money, because smart money are going to know this is happening, and then they're going to be participating in the distribution leg, and that's where we want to participate in. And by understanding the element of accumulation, manipulation, distribution, we understand where price should manipulate. Because if you think about it, accumulation, manipulation, distribution actually exists in candlesticks. Let's say we have a bullish candlestick, right? What happens? So the bullish candle opens, right? It goes lower, and then from the low, it makes the high higher than the opening price, and then it closes. And think about, what does this look like? Open, low, manipulation, and then we have the distribution closing higher than the opening, making it a bullish candle. So accumulation, manipulation, distribution exists within candlesticks. So if we know that we're bullish on the high time frame, we have a bullish bias, right? We want to see the bullish candle print on the day. So what we're going to expect? So we're going to expect price to make a low near the opening price, right? Which is going to be the manipulation, which is that measure of an opposing move against the intended direction, the manipulation. And then price trades into a high time frame level. We're going to talk about levels and key levels price normally turns around at as we get further in the video, but then price hits a level and then starts to turn around and then distributes. Just by knowing this information, we have an edge, because if we're anticipating higher prices and we see price going lower like this, we're not thinking, oh no, price is selling off. No, we know how the candle should print. We have an anticipation of how the candle should print, so we know this is manipulation. Then we're just going to wait and sit around for the confirmation so we can get into the distribution phase of the market. And by knowing what time this happens, by blending time and price, we then have a very high probability condition of how we should act within the market. And this is where the opening prices come into play, and the importance of opening prices, because the opening prices allow us to see where manipulation should take place. The opening prices we're going to be focusing on is the midnight open. That's the first one. And then the second one is the 9:30 opening price. This opening price here, the 9:31, the opening bell, the New York opening bell, is mainly focused around like NQ and ES. So at midnight New York time, if we're bullish, we want to see price trade below the opening price. And why is that important? Why does that highlight accumulation, manipulation, distribution? Well, if price is bullish on buy days, smart money likes to accumulate below the opening price. And if price is bearish on sell days, smart money likes to accumulate above the opening price. So if we know this gives us an advantage, because now if we blend an element of time in here, then it's just going to be like, fuck, now we know where they accumulate. Now if we add the element of the time this should happen, this gives us a zeroed in focus of what time we should expect these moves to happen. Now typically if we're bullish, price usually makes the low of the day during the London session, and if we're bearish, price usually makes the high of the day during the London session. Just by knowing this information, right, it gives us an edge, because let's say now we're bullish on the day. So if we see price trading low and it trades below that opening price during the London session and then starts to turn around from the London session, we can estimate that, okay, that selling off was not the intended direction of the markets, because we already have an anticipation of higher prices. So when we see that selling off, we're not thinking, oh no, price is selling, this is a sell, this is a sell. We're actually looking at that, okay, this is good. This is an indication of that the market is drawing in people who are not as informed. And that's good for us because we understand accumulation, manipulation, distribution. We know that price is going to turn around and give us a confirmation that it's ready to start distributing. And then once it starts distributing, we can then just participate in that move. And obviously price doesn't always make the low in London. So the other times that you do want to look at for this manipulation to happen, if it doesn't make the low in London, right, we still have our bullish perspective on price. Well, the next time frame then we'll be looking at for this to happen would be the New York Open. And if price doesn't use the New York opening, we're then going to use the 9:30 opening, which is the AM session, to look for this manipulation to happen. And typically, let's say we have a news driver, right? A news driver is just high impact news. What you're going to typically see is that price is usually going to wait for that news driver, and then they're going to use that news driver to then trade below above the opening price to then make the high low of the day, and then they'll start distributing price. So just by knowing this information, knowing that, okay, there's certain times of the day where we anticipate manipulation to happen, it gives us an edge, because then if we're bullish on the day and we see price doesn't do a certain thing during a certain time they want, we just move on to the next session. And if it doesn't do it, then we'll move on to the next session until we see the manipulation we want to see, which is that move below the opening price. Once we see that, that's when we're like, boom, okay, now we want to participate in price. And I know a lot of you might be thinking, okay, where does then price turn around at? And I feel like that's where a lot of you get confused and stuck, because you're always wanting to catch the absolute low. I can give you some frameworks of where you can anticipate price to turn around at, but you don't need to catch the actual low for you to be able to make money. You can just trade the continuation and the confirmation, and that's much easier to trade than trying to catch the absolute low. I don't know, there's this culture of like bottom ticking and like top ticking and that. It's all cool, but it takes a lot more experience in terms of just knowing the PDRAs, but you don't necessarily need it to be able to get in near the low or get in near the high. And in this example, getting near the low if we're bullish. And what do I mean by that? Let's say this is the opening price here, right? Midnight New York time. And let's say here signifies the London session open, right? If we're expecting an opposing move against the intended direction, we just think, okay, cool. What is near to where price is currently near the open? And in this example, price is quite in proximity with this 1 hour fair value gap. And we also have a low here. So if we're expecting a degree of manipulation within the market and we have a low here, that's just below the marketplace, right? And then we'll also have an hourly fair value gap next to that low. What you're going to see is that usually price is going to usually turn around at those levels that overlap with each other because they're confluential. So always think to yourself, where can manipulation happen? And that's how I always like to think when I'm looking at the market, is like, okay, where can manipulation happen? If manipulation can happen below old lows and fair value gaps, okay, what are the closest PDRAs to price right now? And if there's a relatively close daily low or low coupled with a fair value gap, there's a high probability chance that at the open, price is going to trade into that. And then from that, we're then going to see, but we don't need to know that it's going to 100% turn around. We just need to wait to see signs that it's going to turn. And that's what we're participating. You don't need to catch it, because this is like trying to catch the absolute low. You don't need that. All you can do is just wait for confirmation. So once price trades into this key level here, is it breaking market structure? And if it's doing that during the right time of day, is it showing displacement within that market structure break? If it's doing that, that's literally a signature in the markets that price is ready to turn. And then now you can start looking for order blocks, fair value gaps to start trading into, so you can now get in with the distribution cycle of the market. So always think to yourself, where can price turn around at? And mark your levels out and then see, is price showing a willingness to turn around from there during the right time of day? And that brings me us into the 9:30 New York opening bell. If we look at London, right, let's say we was bullish on this day, for example, right, and we looked at London and we saw London made the low of the day. We're bullish on the day, so our high time frame draw on liquidity has not been met because we're targeting these equal highs, right? And as price is trading here, I'm thinking, okay, we've already made a low in London, so price has already shown a degree of movement away from that low. So there's a high likely chance that price is not going to come back here. So we're just going to be looking for continuation towards our intended drawn liquidity, because if 930 opens here and starts to trade lower, for example, right, cool, 930 opens here, right, and trades lower. As it's trading here, the manipulation, are you going to be thinking, I want to be a seller? Remember, at these opening times, we're anticipating manipulation. We see price trade lower. Where does price trade to? Maybe there's a close by 15-minute fair value gap, a key low that's quite close to price. Because you know what the drawn liquidity is, as you see this, you're thinking, yes, this is manipulation. And all you need to do is just wait for the confirmation. And yeah, once you have bias and you're coupling with time of day where you should expect to see the manipulation happen, that's all you need, guys. And that's all you need to be able to see the manipulation and know that price is manipulating. Then you're able to sit into the market and get in line with the market. Now let's go look at some examples of this in the charts. All right, looking at this example on gold, right, we have the midnight New York opening price here at 2 in the morning during the London session. Look, price starts to move higher, right? We're anticipating obviously that we're bearish on the day. Cool. So price starts to move higher. You're seeing this, everyone's thinking buy. Oh no, gold is so bullish, right? We're already anticipating lower prices. We have a high time frame level that's in close proximity to where price is. The New York opens, price trades higher into what? Because look, the opening is here, close proximity. We have some highs here and we have a higher time frame daily level here. So what happens? Look, price trades higher into that daily level, and then from that daily level, look, price immediately rejects, breaking market structure, creating that displacement in price, which is that fair value gap that's created as price breaks this market structure here. Price then retrades into that and then trades lower, breaking market structure again. And you see how easy it is. Once the manipulation happened, now price is on the distribution phase. It's so much easier to trade this because now look, breaking market structure again, price trades into a bullish order block. Now you see the bullish order block start to work. Price trades lower again. Price creates another bullish order block. Price trades into it, trades lower again. So when you see price break higher and we're bearish and our drawn liquidity is still not met, take that as a suspect run. Take that as another manipulation that price wants to go lower, and we see that perfectly here. Look, price still hasn't hit that Asia low, right? Price breaks lower here, trades into this order block here, breaks lower, and then what happens? Comes in, creates a high here, breaks above the high, trading into a bearish order block above this old high. We still have our drawn liquidity. We're still bearish. So when we see this, we're not thinking, oh no, this is a breaking market structure high. No, the bias is still bearish. So we treat that as a turtle soup. In this example, as we can see on NQ, we have our midnight New York open here. And during the London session, what happens? Price trades above the midnight open, starts to sell off, sells off, and here would have been our draw. And that was a weekly old low, and that was a daily old low. At 9:30 open, right? We have our weekly old low, daily low here. So we expect price to reject from this area. So what happens? Price does tag below it, come back here, and sort of just lingers around. And look what happens at 9:30, right? Cool. 9:30 opens, price trades below that old weekly and daily low again, trading into what would have been the low of the day here. And look at this beautiful reaction here. So look, price is here. If I'm anticipating price to reject from this low, because look, we've been selling lower all day, there's a lot of people being sucked in thinking that price is going to continuously go low. We're trading into a high time frame key level of liquidity. So we can expect a measure of rejection from here. So at 9:30, what happens? Price shows us that it's manipulating, because at 9:30 open, it trades low immediately, trading back down here. And if you go to NQ, you can actually see that as price made this low here, ES was actually failing and made a higher low. So if this is happening at a key level, ES is failing to go below its old daily low and its old weekly low, but NQ is going below it. Price has been selling all day long. Using that context and narrative, so we expect a measure of retracement from this level, right? So do you see how building narrative around accumulation, manipulation, distribution, thinking where is price near, what is price near, obviously cross correlating that with ES and seeing if there's SMT around key levels, it just gives us high probability. And if we're going to a lower time frame to see the confirmation of this turning around, let's see what sort of confirmation we have. And what do we have here? We have an inverse fair value gap confirmation of that price is ready to turn around after trading into a low, making an SMT with ES. And then we look at this immediate rejection higher from here. And obviously, yeah, that sucks. We didn't get that breast retracement, and they see price trading higher, continue trading, consolidates a little bit, trades into this bullish order block, trades higher, trades back into this bullish order block here, and trades higher. And then you can see how price is showing positive signs of bullishness, because it's now in sync with the distribution cycle of where price should be reaching for. And yeah, guys, that is it for this accumulation manipulation video. I hope you guys found value in this video. Let me know in the comments below what you found valuable, and I'll see you guys tomorrow.